Hello, this is Jim Riggio and Tom Nunemaker. Today is Ja January 19th. Before we get started, a quick disclaimer. Capital Discussion is not a broker-dealer investment advisor. This presentation is for educational purposes only. We don't know your situation, have no way of knowing your level of risk that would be appropriate for you. We're not making any trade recommendations. The risk of trading options is substantial. Please be aware of all risk before placing any trades. Hypothetical and computer-simulated trades are believed to be accurate. However, due to such things as liquidity, slippage, and commissions, your profitability will vary. Okay, and with that, what I wanted to end up going over today was basically three things. The first one that we're going to end up talking about is my daughter goes to Boston University, and she is taking Finance 101. And she got all of the slides, okay, from her classes. And so I kind of went over the class with her. We recorded all of the videos, and I'll go through what they are just at a very, very high level, just a few minutes to kind of take you through. And they'll be available to everybody. They'll be on the home page. We'll show you where they are. And Tom's also going to make them available on the public site also. Second thing, we'll talk a little bit more about, and I've introduced it to you, but the leap rolling diagonal. What I'm going to end up doing is that, this was an opportunistic trade, as other trades that I feel are really good learning opportunities to understand things about, volatility, rolling strategies, risk management. We're going to end up putting them up. This is going to be the first one, and they're not going to come along that often, only when there's a really big, I think, advantage where we have real edge and being able to end up managing that. And so we're going to talk a little bit about just how the leap the rolling leap diagonal will end up working. And then the third thing is that we're going to end up introducing the vol vantage trade. I've been trading this, and I've been studying the ETFs and ETNs on the VIX and the VIX futures for many years. And I've had very complicated strategies that have worked for periods of time, and then they didn't. I think that we're at a point now where the movement of the VIX ETFs have settled out enough that I can end up sharing with you a trade that I end up using as a great complement in my own trading, and I'll explain to you how I end up doing it. So those are the three things. So with that, let's get started right into intro to finance. Please be aware that this is a Boston University class. She had her slides. I didn't have any of the textbooks, but we did end up using my daughter's class notes for a lot of our subscribers. This may end up being rather basic, but there may be one or two things that you might want to end up going over. Here is the course outline. But it's also, I think, a great opportunity to end up just maybe talking to your kids about it, or anybody who's important to you, whether it be, your spouse, your significant other, or, a nephew, or anybody who you may want to end up going through. What we ended up talking about here in the whole class, this is the first class that introduces new students, fresh out of high school, to the world of finance. We end up starting basically from a top-down point of view. We looked at corporate finance, just the function, what financial managers do in different companies. My daughter and I talked about different jobs that might end up being in finance, okay, within, a publicly traded company or even a startup. We ended up using an example of, I asked her, what kind of company should you and I start? And she wanted to start a trampoline company. And so we use that as a basic example. And then we go into some of the examples they end up having. The financial statement analysis is just a cursory look at, the three or really four main financial statements. It does not end up going into this in any detail. It's just a introduction. She has a second class that we started to end up also recording, and this one was called Financial Accounting, and it was basically, it starts on how to end up reading financial statements. And the challenge that I ended up having, and the reason why we're not going to end up releasing that in the form that my daughter and I recorded it, was because it was really very much for somebody who's going to work inside of a company. So if you wanted an accounting class about credits and debits and how to end up treating, let's say prepaid rent versus, other assets, or you wanted to end up learning about depreciation, it would have been great. But I think that would have been kind of useless for most of our subscribers. So what I'm going to end up doing over the next couple of weeks, I have a couple of different websites and examples. A great document from Merrill Lynch, for example, that I'm going to end up using, and I'll end up recording those, and we'll get those out also. We'll put it on the same thing. We'll end up just making it another course in, Intro to Finance. Then comes probably the single most important topic that they're going to end up covering in this class, and what they wanted the kids to end up really learning, and that's the time value of money. If you don't know how to end up moving money, both forward and backwards in time with interest rates and compounding, I kind of think that that's critical for every person. How do you end up taking a look at what makes the most sense when you're selecting which mortgage you're going to end up using for your house? Should you borrow money for other things? We don't go through this in the class per se from a personal point of view, but we do from a corporate point of view. The concept of borrowing money and what are you going to end up using for it. My terms are constructive debt and destructive debt. Constructive debt are any type of business loan that you're going to be making to be able to generate additional capital. If you're using a loan just for consumption, a big screen TV or something like that, very destructive. We don't end up getting into this, and we're not going to touch it. It's only going to end up being around, real corporate type of finance things that you would end up doing, which would be constructive debt in your life. Loans for education, loans for home, loans for any type of asset that would end up increasing in time or being able to end up generating revenue. We go through this. We end up not only go through the different formulas, but what we also end up doing is that I show how to end up doing a lot of the stuff in Excel. Then what we end up doing is just, it's like the second part of valuing money. We go through how to value cash flows. So we'll take a look at, how an annuity might work. Okay, if you're ever considering an annuity, okay, the math is all going to be here on how the annuity would end up working and what you'd want to end up being able to end up evaluating what your cash flow would look like. We also end up talking about perpetuities and other types of financial instruments. The last three classes are probably more practical, but they're very, very basic. We go through what interest rates are, how there are different interest rates. Like, for example, think about if any of you have a rental property. Okay, or any type of asset that would end up increasing in time. So what we would be looking at, like, for example, is an asset that might say start to end up having payments of, $1,000 a month, but that $1,000 may end up increasing by 3% a year, okay, for inflation or whatever it might end up being. And we go through how interest rates end up affecting just about everything. We also talk about the difference about how compounding basically on an annual basis versus, a monthly basis versus, say, daily or continuous, how that ends up actually changing. And we go through some of the formulas on how to end up doing that. I think it's, it's good fundamental stuff to end up knowing. When you look at a company, okay, in section 1, there are 4 types of companies, right? There's sole proprietorships, there's partnerships, there's LLCs, and then there are corporations, okay, or limited partnerships is the third one. And so what we do is that we take a look at publicly traded companies, and in the publicly traded companies, if they're going to end up raising money, there's really only one of 2 ways that a company can end up raising money, right? They can borrow it, or they can sell some of their, selves, right? Some of their shares, sell a portion of ownership. And so we go through what bonds are, how they end up working. And so, again, kind of basic stuff, but, a good review. We're going to end up leaving it out on the website. And again, the criteria or the class materials are all from Boston University. Okay, that's the first part. Tom, I hadn't been looking at any questions. Um, we have
The
a
only
student. Okay,
Yeah,
go ahead.
Mike
I'm sorry.
Schwartz, a BU alum. So,
Go
hey, Mike.
Terriers. Yeah, my daughter here. I'll end up leaving you on this. As a lot of you guys probably know, my dad passed away last week. He suffered from Alzheimer's. When my daughter got back from her first semester, you also need to know that my dad was probably the single biggest Yankee fan in the entire world. My daughter, for those of you who know about BU is on Commonwealth Avenue in Boston, between Commonwealth Avenue and the Charles River. The east end of the campus is literally like from my daughter's dorm, literally maybe about a 3 to 4 minute walk to Fenway Park. And she told my dad, and now my dad hadn't gotten a full sentence out because the dementia had just gotten worse and worse and worse. She told him, the other thing is that my dad had a wicked sense of humor. She told him and said, Poppy, that's what she called him, Poppy, when my windows open, if the Red Sox are playing, I can actually hear them cheering. And she turned to him with that wry little smile that he used to have all the time, and he looked at it and goes, "Why are you a traitor?" Okay, it was great. It was like that was my dad. So it was like what a great memory. Anyway, yeah, Boston University, great school. I'm very very happy for my daughter, and she's a sophomore now, and she just went back to school. So. Any other questions about the course or the overall things? Like I said, I think it's probably a little bit basic for most of you. If there's anything you want to end up reviewing, if you don't remember a particular way of how um, you know um, stock dividends might end up affecting a stock price. We go actually through, a stock dividend model and how if you end up valuing a stock just on the dividend, what it would end up being worth. A little bit, undervalued these days because dividends and interest rates are so low. But I think nevertheless, good things. Again, like I said, probably really good for your high school students or your college students. Okay, if you have them at home. Okay. Um, what I will end up showing you, the last thing here, is that there's also, and Tom, I didn't put this, I don't think I'll have to end up sending this to you, but it's basically all of the formulas that they have to end up going, like, cash flow of annuities, and we go through how the formula ends up working. And so it does go through, okay, as you would end up expecting, any business classes to go through. They go through, details. Things that really affect us, things like what are real interest rate versus nominal rates. Okay, we kind of go through a lot of that. I told you APRs, okay, and effective annual rates, discount models. Okay, and so we'll put that up also there, Tom. I'll end up getting that to you shortly. Okay.
Okay, I'm already up to bonds, so the page is almost done. So.
Okay, and what I'll have to end up, because this is in a different Dropbox. This is in my daughter's Dropbox, so I have to end up sending this one to you. I'll do that after the class. Okay, the next thing we wanted to end up doing is we wanted to kind of just end up going through. Tom, here, I'll end up opening up that URL. Okay, let me open up that URL that Tom is basically uploading stuff right now. It's going to end up being on the home page. If you take a look at it, Tom, is it off of classes?
It will be. It's not there yet.
Okay, it's not there yet. Okay, but here's what it'll be. You'll end up seeing. Okay, I did write up so you can see what's in each of the classes. It's there are some supplements. I see that you have the time supplement here, and then we'll end up having the actual class 3 in front of it. Some classes were so long I broke them into 2. Okay, and the videos are there with the descriptions. They'll be available both on the public site and on the member site. Okay, and with that, what I want to end up doing next is I want to end up going to what we're going to end up doing Okay, for the rolling leap diagonal strategy. Okay. And if you guys haven't seen it, I've done a roundtable on it. I also talked about it on Monday Market News. I'm not going to go over the specific trade now. Um, I do need to do a roll, so maybe what I'll do is I'll schedule something probably tomorrow. I think I'm going to end up doing the roll. I'll end up going through how it ends up working. But right now, all we end up having is just the specific trades. What you're going to end up seeing in the class, and let me end up just taking you know, the way the class structures. Anybody who currently takes a class or any of our alert services that we end up having, this is the way they're set up. And again, this is going to be a free class. Anybody who is a member, a subscriber, a gold member will all have access to this. I will end up doing a monthly WebEx after I do my roll. I will be doing one roll a month. And we'll be recording all of just the way we've done in the other classes. We'll have the videos. I will end up putting up a couple of images a month when I'm considering my role, what my trades might end up being, what I'm looking at. It's not going to end up being like any members who subscribe to a service like the Road Trip or the Kevlar or any of the others, you know that we send out updates almost every day. This one, it's one trade a month. So what I'm going to end up doing is just basically doing one WebEx and maybe a couple of images, and that's going to end up being it. We're not going to end up sending out text messages, but I will send out emails. So anybody who wants to end up getting the email, can sign up. I will send out the email whenever I'm doing a roll. Okay, so you guys know what I've rolled to and where I've rolled to. We will end up keeping our current positions, okay, and you see open right now. We'll basically have a history and what I currently have open. We'll end up keeping a history of the performance. There's not going to end up being any tools or docs or frequently asked questions. You'll be able to set stuff up on it. What we will end up doing is that we'll also have a forum. Okay, so that you guys can chat. I'll end up getting on it once in a while. It's really about risk management, and that's what I wanted you to end up seeing. Like I said, I'm not going to end up going through the whole trade again. Those of you who ended up watching, like I said, the video, you've seen me go through it, but I will end up just mentioning. Okay. The whole premise of the trade is that when I ended up putting this trade, the initial trade on, I put the initial trade on back on January 9th. And on that day, 2-year volatility and also 1-year volatility, meaning 360-day volatility, was at a multi-year low. So was 720-day volatility at a multi-year low. So the advantage, okay, that this trade has is that we bought basically what I call an anchor, a December 2018 put at a very, very low price. What we are doing, or what I'm doing at this point, I am going to sell puts against it. A couple of quick comments. I just want to make this. If you're going to end up doing this, do not do it yourself with calls. People end up taking a look at calls and they'll say, oh, the calls worked so much better. Yeah, but what will end up happening is that the first time you get assigned because a dividend comes out, people end up being shocked and not have to end up dealing with it. So from a learning perspective, puts were just easier, number one. Number two, I've looked at this and people say, oh my God, look at that risk management. It's absolutely terrible. If we move up or down, you're absolutely dead. And the answer is, if I was putting this on one time and looking at this on a monthly basis, it's not that great. But I'm going to end up rolling this 23 times. If the market goes down significantly, two things happen. Number one, implied volatility goes up much more in the front month than in the back months in most cases. You also end up trading this very, very different after we already have a 5 or a 10% pullback in the market and vols start to end up going up. The amounts of money that we'll receive for the new options that we're selling is significant. And so it tends to end up working, very well. The challenge on this more so is if the market ends up running straight up because then volatility comes down and we don't get to end up selling as much. Now, I don't worry too much about the back month volatility going down because I already bought it at a 2-year low, but it's going to end up being harder to end up making money. I was sent a question, what can I end up expecting to end up making on this? To which my response is, you're doing this to learn. Don't expect to make anything. What you're going to end up learning is how to end up understanding how volatility affects pricing, and to be able to not only learn how to roll, but how to do risk management. It's not a coincidence that I use two contracts. I use two contracts for a very specific reason. Number one, okay, it was the lowest amount of contracts that I could end up using on the smallest SPX index that I could end up using, meaning that whether we go to zero or infinity on the SPX, right, the most that you can possibly end up losing on this is under $5,000. Okay. Now, having said that, I'm not doing this not to make money, right? I'm going to end up doing this because I think is that I really think that I can make money. If you guys have heard me speak before on my Kevlar or other presentations, I'm pretty fond of telling folks that whenever somebody asks me to look at a trade, institutionally, usually. And I don't do this. That was another thing. I've been asked if I end up doing mentoring sessions. And Tom, we can talk about it, but I really don't want to end doing them. I'm too busy at this point. I'll end up always asking you, my very first question is, what is your edge? Explain to me why you think your trade has a statistical advantage. Okay. Now, if you can't answer that question, you don't have an edge. And who's ever trading against you probably does. I use the analogy. I don't play poker, but I have a lot of my math buddies who love the game. I was always a blackjack guy. When you walk into a room, a lot of times people say, well, they'll look around to see who the sucker is. If you can't find them, the sucker's probably you. Okay. Know what your edge is. Our edge is that we bought long-term volatility at a multi-year low. And there's probably a chance that, the VIX might get above 11 or 12 at sometimes during my 23 rolls or 22 rolls that I might be able to sell a higher, VIX. Now, that's my edge. How can my edge be taken away from me? If the market moves up or down too much. I started this in a multi-month mode. What you will see me do is that when volatility is low, right? I sold one, if you take a look at the front month, right? I sold a January and I sold a February. I'm only going to end up using monthlies. Some people have asked me, can I use weeklies? Okay, the theta is greater. Yes, the theta is greater for that day. But what ends up happening is that if the market ever moves substantially, you haven't collected enough money, I think that you're taking, it has more risk than I'd like. I'd rather collect chunks of money when I end up putting these things on. So, for example, and I've also gone through how I end up doing this, so you guys can watch one of the other videos. But what I end up doing is that, just so you know my notation really quick, if it's locked, I've already put the trade on. I told you I put these on at 11:23 a.m. in the morning on January 9th. Okay, these were the prices that I got. I can end up doing this. I can end up selecting both of these. I can end up hiding my positions, and I can take a look at all of my Greeks, and then I can hide my simulations, and you can see all of my Greeks haven't changed. So I haven't made any adjustments, so this is the way I end up keeping my trades, right? It's just easier for me to do it this way. I don't have to go start another piece of software. I was never a huge OptionView, OptionNet, Explorer guy. I know that Dan Harvey and other folks said this is a little bit more difficult to do this way. For me, it's not. Okay, for me, this just works. For other people, I realize it might be more difficult. What I ended up doing and what's on the website is that I will always keep a look and I'll end up tracking, what my rolls are going to end up being. Like, for example, if I end up rolling, in a calendar. I take my January and I roll it out 1 month to February. What you'll see is that I get $1.76. There's only a day and a half left to end up going. If I come and I take a look at the January, we don't need 60 strikes, right? We don't even need 10. So you can end up seeing here, okay, that there's 85 cents, okay, of which 33 of it is extrinsic. That means that I have 53 cents of time value left. So I really don't want to. I'm sorry, I did that backwards, didn't I? The time value is the extrinsic. So I got 33 cents of time value and 52 cents of intrinsic value. So I definitely want to end up rolling this. I'd like to collect, a little bit more. I'll look at this before the end of the class. Chances are I'm probably going to end up rolling tomorrow morning. Okay, but we'll look at this before I end up going. Bottom line is that I'll take a look at this and I'll say, well, how best to end up managing my risk on this? Like, for example, if I roll at the money with the diagonal, the other day when we were looking this, it was $1.79. It's going to end up depending a lot on where the different volatilities are. So what I'll do is that I'll come and I'll take a look at two expirations, okay, and I can see what my expiration graph looks like. Pretty reasonable. Remember, I told you the downside line is understated, meaning that if we get really crushed, the loss won't nearly be this bad on the downside. The loss on the upside is pretty much where it's going to end up being. If we go up more than X percent, I would worry about this if the back month volatilities were high. If the back month volatilities were high, then I would tell you that the loss on the upside is understated, meaning that we would lose more, okay? Because volatility is low right now in the back month, the downside is going to be better than expected. The upside is going to be about the same. If the back month volatility at some point, if we start facing a 30 or 35 VIX and the back month ends up moving up, then I can end up telling you that the opposite would happen. If we end up moving up, okay, because the front month vols would end up getting crushed, we'd look a little bit better. And on the downside, if the front month vols went from, let's say, 40 to 80, okay, because we went into free fall, okay, 1987 type crash, then it could end up looking worse. But what I'll do is that, and this is why I think I chose this trade, I think it'll end up giving you a really firsthand look at the difference between the theoretical lines that you see on your graph and the way I'll trade it practically, because I've done this before and I know what to truly end up expecting and where my T plus 0 lines or my T plus 7 or my expiration graphs will end up looking. Expiration graphs, one of the reasons why I believe most people really like to trade verticals or butterflies, broken wing butterflies, condors, or keep things in the same month, is because your expiration graph is your expiration graph. It's not going to vary. Here on this expiration graph, okay, if I did this roll into February, that expiration graph isn't accurate, because what's going to happen is that even when we expire, I'm still going to have the January 2018 puts. And so they're going to be affected, okay, by price here, right? This line is very, very accurate when it comes to the price, and they've calculated the time, the delta, and the gamma perfectly into expiration. Here's what they can't calculate. They can't calculate what's going to happen to back month volatility. And that back month volatility is going to have a huge effect on how high or low this profit actually is when we get there. Therefore, if you take a look at, and I've gone through this in another class, so I'm not going to end up going through it in detail right now, but you can take a look at how low, okay, the Vega number is for our current strike, right? There's only a day and a half left before expiration, right? We have 6 cents of Vega. Whereas if you take a look at my current 225, or if I roll to 227, if we just keep it 227, here my Vega is 26 cents. So Vega is going to end up affecting things much more the further you go out in time. And if you take a look at my position over here, I don't have enough strikes on this one. I think I'll need 14 will get me there. Okay, here, okay, if you take a look, my Vegas $1.19, right? So we're going to end up talking about, and I'll do this in the monthly videos when I do the roll, how I'm rolling it, why I'm rolling it, what the things look like. So I really hope you take the opportunity to end up learning. I'm going to end up using this as a way to end up teaching what I would consider to be the fundamentals. Okay, this isn't going to end up being all about skew or how a broken wing butterfly works in certain environments. This is just a single strike, right? And I think that getting the basic blocking and tackling type of fundamentals down, this will end up helping you, I think, with a lot of the rest of your trades. Okay, um, if if we rip higher, will I move my longs? The answer is that was a question that was sent out. The answer is I would really resist doing that. I may have to. Um, the way I plan on rolling my longs, okay, and this is a long-term question, right? Because I'm not going to end up rolling them hopefully for a while. Um, I probably will not roll my longs. I will adjust where I will sell my puts. Okay, very, very important. Um, the advantage that we have if we run up, okay, and let me show you this for a second. Okay, and let me just get the right dates on here. I don't want December. I would just want. I'll leave this. I'll leave the December. Just give me 30 seconds, and I'm going to end up explaining what I have here. Um, okay, what you're looking at is live vols skew, okay, for the SPX. And you know what? I'm doing this on the SPY, so I'm sorry. It'll take a second to end up loading the data. It's going to be almost the same, but let me pull up the SPY. What we're looking at here, and let me, of course, I have to end up unchecking all of the stuff that we don't have. Let me just get the January, March, December of 18, and December. Okay, so what we're looking at here, this red line is the implied volatility at each strike going up and down, okay, for 10% up, 10% down, only for strikes that are trading at a quarter or more. Okay, so you can see that the implied volatility is much, much higher. And if we go and we take a look at the 220 that we bought, we can see that the implied volatility is just under 18. You see that? It's at 17.94. And you can see the bid and ask spread. Okay, bid and ask spreads are always going to be wider when you go much further out in time. Here's the implied volatility at the January. Now, if I come over to here, here's the 227. Now realize this is the last strike that's trading over a quarter. Why haven't I rolled this? Because there's still, it's trading over 25 cents of extrinsic value. What they do here, by the way, they always use the out-of-the-money strikes, and they try to end up then adjusting the interest rate to account for what dividends are going to be paid between now and the expiration. So therefore, my volatility looks a little bit more accurate here, a lot more accurate here than it does on Thinkorswim. That's why I like to end up showing this one. Anyway, so this red line here is my January. So now what ends up happening if we run up significantly, okay, I probably will not, okay, roll my long December put up. Now, if we run up, two things are going to happen. Number one, the further we run up, okay, it's kind of like shifting the entire curve. So if we run up, a number of points, that means that my long 220 right here is going to get further and further from the money. So what you can see is that the implied volatility is actually going to end up going up a little bit. Now, it doesn't make up for the loss, it's not even close of what I would end up losing in my value, but it helps offset, okay, a tad, a little bit of the loss. Number two, I would also sell puts, that would be further below the money because I'd have to manage my delta. So that means that instead of selling, like right now, if I roll to the 227 in February, I'd only be getting a 9 delta. If we rolled back, if the market ran up, I would probably, and we were, let's say, another 10 points above the money from where we are right now. Instead of selling the 227, maybe I sell the, the 220, not a full 10 points, but, a chunk of it. So if you take a look here, I'm selling a much higher implied volatility. So I would rather you learn how the volatilities work than adjust so this way you could follow the same rules all the time. Okay, I'm not going to end up giving you any set of rules. This is going to be, here's how you evaluate a trade, and you learn how the art, not just the science, but the art of trading ends up working. Okay, and I feel that this is probably the simplest, easiest trade that I can end up doing, that one will have an edge, okay, for you, and two is a great learning vehicle, a great learning trade. Okay. What happens with margin? Okay. Your margin will go down. Okay, because here's what ends up happening. Okay, when I put on the first trade, and let's just look at the January trade, right? Because this was the January where I was short the January. This one up here is the February. You guys all see that? And you can see that it cost me more money to end up putting on the DEAS Jan 17, right? The DEAS 2018, Jan 2017. It cost me more money than putting on the DEAS Feb. Of course it did. Even though that there was a 2-point difference, I sold the 127s here, and I sold the 227s here, and I sold the 225s here. I was selling a lot more time, right? There was only, less than 2 weeks to go, okay, when I put this one on, and over here there was, almost 6 weeks left to go when I ended up putting this one on. And so it cost me less money because I was selling more time. Now, if I rolled a 227, okay, from the monthly Jan expiration to the monthly Feb, you can see that I would collect $1.74. So when I take $1.74 off of this, you can see I'm paying a lot less when I roll this thing. Okay, now granted, it's not going to be the same strike, but how about if I rolled it to the same strike, and that's this one right here. If I rolled it from January 227 to February 225, if I rolled that one, you'd see right here that I would end up getting $1.06. Still, $1.06, if I subtract it from here, comes out to be what is that? $17.28. So it's cheaper than what I would have originally put on, right? So I'm going to have an advantage. And so what you'll see me do is that when vols are very low, I'm only going to end up rolling, okay, the minimum amount per 1 month. What you'll also see me do, if vols get to end up being rather high, and there's a big difference between how much I can end up getting between selling the front month and selling the second month, I'm going to sell the second month. Okay. Some people have asked me, Jim, I don't understand. Why would you end up rolling this, okay, to just January? What you're doing from January to February. Here, you're only getting a 9.6 vol. You guys see that right there, 9.62? If you rolled it out to March, you'd get a higher vol at 11.8. Okay. To which I'll respond, do you really think 11 is a high vol? Okay. All that has to happen is, I don't know, the slightest geopolitical thing goes wrong someplace, okay? The honeymoon period that the market is in, okay, with the new administration coming in, doesn't go as perfectly as they plan. And vols go higher than 12. I'd rather not sell a lot of Vega. Very important. Hear what I said. I'd rather not sell a lot of Vega. I didn't say implied volatility. I said Vega when vol is low. What do I mean? We went through this before. This is what I was talking about. If I take a look at let's make this a little bit bigger. If I take a look at the Feb and the March Vega, right? Because that's what I'm doing. If I sell an option, I'm selling Vega, right? Because if I buy the option, it's long Vega. If I just let's just stay with the 227, okay? So we can compare the 227 to 227. I'd rather sell the 26 Vega and not the 36 because even though this implied volatility is 8.3 and this one's slightly higher, if the markets jump, okay, this Vega will end up, okay, moving at a much, because it's bigger. I'd rather not take that potential risk, right? Why am I doing this? I'm waiting to sell a higher Vega. So why would I end up trying to sell more time right now when volatility is low? No, I'm going to sell more time premium, more Vega when IV goes up, okay? And again, being able to end up watching that as the different implied volatilities of the different months, of the different strikes, as they end up moving, you'll be able to end up seeing, what my thought process is, what I end up going through. We'll end up having a forum, so you guys will be able to end up talking about it. It'll be open to every Gold member and every subscriber, so there's no additional cost to it. We thought about charging for this for non-Gold members, and we thought, you know what? The Gold membership is so cheap. Just buy the Gold membership if you want to end up going. Tom, I forgot what it is. It's like I think $15 or $17 at this point. We did raise it, by the way, at the beginning of the year. You guys probably didn't notice it because if you're a Gold member, okay, you're not affected by any price increase. Tom and I will end up keeping the prices the same for Gold membership no matter what ends up happening. We're going to try to end up keeping it the same on an ongoing basis. So for you guys, you've been grandfathered. Okay, this is yours, no additional cost.
It's
Okay.
1750, by the way, or 175 a year.
Thank you. Okay. The reason why my margin doesn't end up increasing, it decreases over time, okay, is that when I go and I collect this, let's say I go and I collect this $1.77, okay, here's where my trade is. Let's go just one expiration for right now. You can see here the maximum loss that I could have is $4,774, okay. Once I go to sell this, I'm collecting $1.77. Let me lock it, $1.78. Let me lock it so the price doesn't change while we talk. I'll unlock it as soon as I'm done. What you'll see is that we're collecting that. So that means that my maximum loss is going to be reduced by the money that I collect. I'm collecting one contract, which means I'm collecting $178 minus commissions. And so you can see that my margin ends up becoming less. Now, what happens when I roll if I rolled it out to March, the following month? And let me show you what that ends up looking like. Here's the roll of the February, and here's the roll if I rolled it out to March. Now look at where my risk is. Okay? So my goal is to get this margin to be reduced each and every month, to be less and less and less, okay? What I would plan to end up doing if this was going to be an ongoing trade, okay, I would wait usually at least a year, okay? I'd want my 24-month or my 23-month, okay, time to expiration, and let me just uncheck these things and get the actual trades here. I'd want to get this December. Maybe next year around this time, I roll it. But I'm only going to end up rolling it, okay, if the new vol, okay, is low. If the vols are high, both the current vol, okay, meaning at the time, if it's 1 year from now, we'll be looking at the December 2018 and the 2019. Okay, if vols are high, the difference between those two are going to be greater. If the vols are low, it's going to be lower. This is a really important trade because one of the things, and I don't have the hedging class completed yet. As you guys, as I said, I've been distracted over the last few weeks. There is a variation of this, okay, that I will end up showing you. That's probably one of the most effective hedges I've seen. it's very, very important to be able to end up having a hedge that works in the real world. Um, I've seen people put on hedges that are negative vega, okay, or hope that if the market drops, 10 or 20%, that the VIX doesn't go up, and look at how great my trade looks if the VIX stays the same. You can't make those assumptions. Okay, you think about doing something like that. That just tells me, you've never traded it in the real world. Okay, because the real world will end up, okay, just chewing you up and spitting you out. And I know people say, well, I looked at it, okay, in Option View or OptionNet Explorer. The problem is that you'll never get the same exact skew and change in volatility, and there's certain things you're going to have to end up doing. So when I end up showing you how to end up hedging, um, this will be the last method. Like I said, I'm going to end up using some version of a diagonal, and I'll end up showing you how that ends up working. But you need to end up knowing the basics. So if you're thinking about taking the hedging class, which we'll probably end up announcing by the end of the month, and again, that's my fault. I'm sorry, it should have been out already. Um, it'll be important that you end up following this trade too. And like I said, there's no cost to it. Okay. What's the maximum margin or debit I'd end up paying for the spread? I have no idea what it's trading at right now. Okay, you can't end up selling the January, right? Because this one is useless. This one is not at 740. Where's it trading right now? It's only trading, 29 cents above it. So it hasn't moved that much. We're not going to make a lot on this, by the way, guys. It should be a slow and steady. Every once in a while, we'll take a loss because the market will move outside of a range. But, I think that we should probably win, three-quarters of the months, okay, from because of the edge that we end up having. It's going to depend, right? It's always going to depend on what happens in the market. Tom, I think I answered all of the questions. Are there any others in there?
Uh, no, there weren't that many questions, so I think
Okay, good.
yeah.
Okay, good. So let me end up, closing this, and let me come over to here and talk about. Let me just go back to the homepage. Talk about the Vol Vantage. Okay, we're going to end up putting this on the homepage. We'll probably end up giving everybody this, free through at least the end of the month. What the trade does is that we look at, or I look at vol skew all the time. Okay, let me do this. Let me end up taking a chart and bringing this up over here. Okay, first things first. Let me make this as long as I can make it. Oh, it is there already, right? Did I already have it? I already have it. It's already at max. This is a chart of the XIV. This is basically the inverse of the VIX. Okay, the Vol Vantage trade has three states to it. The first state, and the one that's most common, will be long the XIV. When we have attractive contango VIX futures pricing that end up having an attractive yield to the XIV, okay, I will be long the XIV. I've back tested the system for a long time, and I've looked at it, and I'm not going to give you, the back test results, and I'm not going to make any claims about the back test results. We've gone through this. I've been doing institutional work. I end up having, and I will end up reinstating, my securities licenses, this year, and it's a whole pain to end up doing it. What I did was that I started to end up doing this trade after the election, and I got into the trade initially on the 15th. Okay, the role characteristics were very, very positive on this day. I didn't know if I was going to end up doing this or not. Being the trader that I am, we went up from 39.34 up to 39.90, so I just took my profits and I ran. I was an idiot because a few days later I said, you know what, I should be doing this. I can end up helping a lot of folks to end up having a really nice complementary system. And you can see that I ended up getting into trades here on the 22nd and the 23rd. I felt a little bit piggish. Okay, I didn't get a sell signal. I felt a little bit piggish on January 4th, so I reduced some of my position. I put more money in it than I probably should have because it was so attractive. So I basically reduced my position down to the 800 shares that I have right now um, on on in this account. If I brought up the trade, you'd end up seeing that it's up about 30%. Okay, the capital that I put into this, and I still have open. Okay, obviously I made a little bit less on here, but the money's back in the bank and it's in cash. Um, State one, okay, of this will be long the XIV. Let me just go over real quick. State two will be when we're more in modes where we're being chopped around, and I'll end up being in cash a fair bit of time. The third part of this will be when I want to be long, okay, the actual VIX and be long the VXX. Now, this is a long-term graph of the VIX, of the, I'm sorry, VXX. Let me see if I can't end up showing this to you in, I thought it was here, manual. Okay. Will that work? I don't know why I can't use log scales. Guys, am I doing something wrong here? I want to use a logarithmic scale. If I come over to here,
It's like it has log scale.
yeah, it does, right? I don't know why it's not working. Okay, right?
It doesn't look like a log scale to me, though.
It is not a log scale. Trust me, okay? This is not a log scale. If I was to put this on a log scale over this, whatever, 7-year period or so, 8-year period, you would see that this would pretty much be a straight line. And I can show that to you because you can see, well, we lost most of our money here. If I end up just highlighting here, all of this line is straight, right? So let's just highlight, let's say, this part. Well, that didn't work out. It still goes down, right? So obviously from here, right, the last 3 years we've been flat, right? Let me highlight that. Well, look at it came down. Well, it only came down in the first year, right? So let me highlight, right? And you can see that we just keep coming down and down and down. Oh, there we go. We're in a log scale now. Now it's log. Okay.
You probably just had to redraw the chart.
Okay, that's probably what it was. It probably wouldn't do log. Okay, here we're in log scale. Okay, so you can see what ended up happening is that if we look just during from 2015, okay, right, from the end of 2015 to now, right, the year and a half, you can see that, look up here, we're at 120, we're at 20 now. Okay, the challenge of why you can't end up being short this is twofold. Okay, the first one, this is what it looks like in a non-log scale, right? Is twofold. Number one, when you take a look at some of these things, it's very possible that the VXX doubles or triples in a few weeks. If you've ever been short, okay, a stock that has doubled on you, you will never do that again. Okay, the pain is unbearable. Number one, right? So your upside potential for loss is just absolutely horrendous. Number two, okay, you'd want to end up buying puts. I can tell you for the first year and a half, okay, if you bought a put with any amount of time, you made money. The markets underestimated how important the roll yield is. I'm going to get to roll yield in a second, okay? So it was just way, way too expensive. Okay, the puts have gotten to be a point where now not only do they have implied volatility, but there's estimated. So the math behind it is so difficult. And I tried for over a year to saying, well, how do I end up doing this with options? And I just couldn't find anything. So I said, screw it. It's an easier trade. We're just going to end up either being long the XIV. You'll hear me call it 14 a lot of times, right? It's Roman numeral 14. Um, you'll in cash or long the VXX. Those are our three states. Okay. Any questions about the basic stuff? Because I'm going to go into, I want to go into why the VXX is a flawed product and why 14 is a flawed product. Okay. The VXX, okay, role, okay, is the following. Okay. What ends up happening, the way the product works, is that it was originally started, okay, as you can see, before I show you the VIX Central stuff, let me come over to here, right? If you take a look, it was started, okay, in, the middle of 2009. What happened as the markets were crashing, okay, the Credit Suisse sales guys kept saying, oh man, I wish I could end up selling a VIX product. I could make so much money, okay, to my institutional clients if I could sell them a VIX product. The problem is when you take a look at VIX futures, okay, number one, a lot of people didn't have futures account to be able to trade it. Number two, you can't buy it and put it away and hold it. So, for example, what you're looking at here, and if you guys haven't watched the VIX Central with Eli when he talks about his website, you definitely should, right? It's a great free resource. If I was to go and buy a longer term, like September, okay, VIX future, you can see I'm already paying almost 20. Okay, so if the VIX goes up between now and then, how much of it is really going to end up helping me? And if you go and you take a look at this, the 6-month volatility, if I could even buy something longer, when the VIX ends up jumping, okay, the long-term stuff doesn't jump that much. It always jumps in the front month. What is the VIX? Let's start with this. It's a calculated index made up by a formula by a bunch of math guys that worked for the SIBO that said, let's calculate about how much the implied volatility is on the S&P 500 options out 30 days. Now, tomorrow, they have to recalculate it using a different set of options, right? Because if there was an option that was 30 days yesterday, well, today it's only 29 days to expiration, and tomorrow it'll be 28 days. Right? So it keeps decaying. So if you were going to end up building a product, okay, that had a constant 30 days to expiration, what we would have to end up doing is we'd have to buy some of the first month and some of the second month. Let's make believe that the front month was going to end up expiring in 15 days, and the March was going to end up expiring in 45 days. Well, the average of 15 and 45 is 30, so that means it's a 50-50 split, right? That means we need 50% of the options from February and 50% of the options from March. But what would happen tomorrow? Well, we'd have to sell a few, right? Because now the 15-day, the front month, instead of having 15-day DTE, days to expiration, it's only going to have 14 days. And the second month, instead of having 45 days, is going to be down to 44 days. So how do we get the average to be 30 days again? The answer is simple, right? We'd have to sell some of the 14-day, okay, and use that money to buy the 44 days so that we'd have the new blended average, okay, be 30 days. So that means every single day, including making allocations for the weekends, okay, this VXX has to sell some of the options that are trading at, and I can't end up pointing at it, okay, so I'm going to have to just keep it up here. We're going to have to some that are trading at $14.13, and they're going to have to use that money and buy options that are trading at $15. I'm sorry, futures. I said options, right? It's buy futures that are trading at $15.52. That difference right here is a 9.84% loss on the money that we ended up having to end up rolling our futures. Now, if you think, well, how much do we have to end up rolling our futures? By the end of the month, you're going to have to roll 100% of them. So that means theoretically, right? Let's think about it theoretically, and we can talk about how it actually trades in a minute. But theoretically, if nothing happened to volatility in the first 2 months and nothing happened at all, that means at the end of the time period, we would end up losing 9.84% 8% if volatility stayed exactly the same and nothing changed for a full month. This loss we call roll drag, right? Because we're rolling our futures, okay, and we're going to have to end up buying higher prices because the longer term futures are more expensive. Now, the question that immediately comes to mind is, well, how long are we in this pattern where the front months are lower than the back months? By the way, the front months lower than the back month, there's a name for that. We call that contango. When the front months are higher than the back months, there's a different name for that. We call that backwardation. So basically, what you have to end up taking a look at is making an estimate of where the roll yields are currently, where they're going to be next month, maybe month after. You have it trending for you or against you. And if we were to go back from the time I put this on, we've had very attractive roll yields. When I ended up giving this trade, and I've been telling my Kevlar subscribers basically since I put it on, if I've been long and if I've traded anything, nobody's heard anything over the last month or so because I haven't done anything. I've just been holding it. Okay. It works well if volatility is low and stays low. People were saying to me, how could you possibly be buying the XIV when the VIX was at 12? Well, I have, and I've made 30% on it. Okay. I'm pretty happy with the trade. Will it get hurt? The answer is yes. There is no easy way. Okay. You can spend the rest of your life trying to end up figuring out how do I end up, buying, at the bottoms and selling at the tops, and there's just nothing. There's no way to be able to end up doing it. The best thing that you can possibly do is try to end up riding through smaller pullbacks on the XIV to end up getting through them. The secret sauce, right? The key is, when do I get out because the pain could become too great? I had several of my Kevlar subscribers, sending me panic emails on these days. Oh my God, we're going to give back all of our profits. Yeah, there was a possibility we were. Okay, but the probabilities, the way the VIX futures were, we were still in contango, going out several months, and going through all the math that I end up going through on this stuff, it had a higher probability to end up holding the trade. Okay, and that's what I did. If we had come down, would I have been wrong? And the people who were afraid to end up selling here, would they had been right? Yes, they would have been. I knew I had probability on my side. It was also what ended up happening. You can end up seeing here. It was also the last day of the year. There was a lot of adjustment trend that happened sometimes, and so I decided to hold. I shouldn't have done this, but I heard everybody say, "Oh, I was scared here." So when we made all of our money back some, I felt, you know what, I've made everything back. Let me reduce my position a little bit. So I did. Like I said, I didn't get a signal. I will be holding this. And when things get to be a little bit less certain, or they get more scary, I will end up getting out of this. I will either go into cash, and usually I'll go into cash the next day. But sometimes, depending on what happens in the market, I may go directly from being long XIV to being long VXX. Let me end up showing you the way because I showed you the way. Is this? No, I didn't do it here. I wanted to end up getting wrong one. This. I showed you the simple way to take a look at the percentages. It's there all the time. You can go back. You can take a look at it. But here's the way I actually do the work. I end up, and I haven't adjusted this on purpose for you. Let me come over to here. Get a VIX term spread. This is what I track. The blue line, you can see it ended here. The blue line was the front month. I say the front month because the January just expired. So this was, and blue line over here is the January. The green line is the February. Okay, so what you're looking at on the top is the VIX cash. And there is no VIX cash, right? Remember, VIX is the only future where you can't trade the cash against the future, which means there's no way to ARB the VIX futures. Very important, right? It's the only future that cannot be ARBed. Okay, so now it becomes a real trading vehicle, and institutions would use it all the time. Some of you guys know that during the time 2 years ago and a little bit for half of last year, I did a lot of consulting work. One of the companies that I ended up doing consulting work for was a high-frequency trading firm based in New York, New Jersey. The VIX was the product they traded the most. Okay, it was the one that was being traded for direction. They'd end up using that to end up doing high frequency trading against the overall market. It was just a great, high speed trading vehicle for them, which means that it's a shitty high-speed trading vehicle for us because their networks are faster, their algorithms, you can't end up trading it. Just save yourself the money, time, and aggravation. You can't end up getting in and out of this thing at the speed that they do. Can you play swings? Yeah, you can play swings. So you can end up seeing, in this blue line, and let me come over to here to end up showing you my studies. This blue line, right here, this one. Oh, wrong one. This blue line was the VIX F7 versus the VIX G7. For those of you who haven't ended up memorizing, your VIX futures contracts or any of your contracts, F is January, G is February. So I'm basically taking February and I'm subtracting January from it. I'd love to be able to divide it by January so I could have a percentage just the way Eli's done on VIX Central, but you can't do division in a formula. It's a limitation of the Thinkorswim system, and I haven't written ThinkScripts to be able to end up doing it. I'm not going to end up doing that because I'd have to rewrite them every month. So what I will end up doing, after I end up showing you this, I'm going to redo my graphs so that I am going to end up changing the next month, and they're not in order. I should end up having them in order, but I don't. So let me take a look at I'm looking for the H. Where's the H? Here we go. Okay. The H, again, for those of you who don't have it memorized, is March. So here what I'm doing is I'm taking March and I'm subtracting February. So this is the difference between months 2 and 3, right? And here's the difference between months 2 and 3. And then here's the difference between months 4 and 5. So you can either stare at this, keep your numbers all the time to see which is trending and which is broken down and which way things are going. Or, the way I've done this is that I actually just keep track of the difference between months 1 and 2 in blue, the difference between months 2 and 3, in green. Yellow is the next 2 months. Orange is the next 2 months. Red is the next 2 months after that. So basically, I'm looking at the difference between months 1 and 2, 2 and 3, 3 and 4, and so on, out to month 6. The other ones are longer term. I put them down. I kept them in white and gray. They really don't trade. They're more noise than anything else, but I like to see them as they come onto my graph. Now, what I will end up doing is that when these lines become distressed, at certain points, and I'm not going to end up sharing, the specific mathematics that I end up doing behind this. I've done it with a partner. It's confidential to the other firm, but I can end up trading it, and I can end up sharing the trade. I'm not going to end up giving you my backtest results. There are too many engineers out there. I know you guys are going to sit there and you're going to try to reverse engineer it, and it's not fair, to folks. So this is the trade. I will end up staying long the XIV until we get to a point where things become somewhat stressed. I also look at this where I'm just looking at the term structure. And what you're looking at here, is each of the months and the volatilities where they end up trading. So I'm using the same colors. If you take a look at the January, you see the G up here? Okay, the G up here, if you remember, okay, that was February. Okay, so here I'm going to look at February, and the dark blue line was the January. You can see the January ended trading here. Okay, um, and you can end up seeing that we end up having to roll, okay, up to here, and then the VIX ended up from the roll date. It ended up trading pretty similar. And what I'm doing is that I'm not looking at the VIX. See here, I'm plotting the front month. So you'll always have the overlap because I'm plotting the same thing. I just wanted to have the blue line on one side, and you'd be able to see it end up jumping. I'll end up changing everything. I'll roll everything out. And again, we're basically looking at the difference between the lines. And I want to see, if they're contracting, if there's any noise in the lines. I call this, you know, perfect contango. And here's what I consider perfect contango. When I go out at least 6 months, okay, and each one is lower than the next. Here we're not in perfect contango, but we're still pretty good. Okay, when we're in perfect contango, there's no reason to be long to worry about things. You have to start to worry at a certain point. Okay, so here's the way this trade service will end up working. And let me come over and, oh, I already had that. Let me come over to here, and again, I'll end up showing you what we're going to do. I'll use the Kevlar as the base. Okay. I will end up doing libraries. I'll end up doing a video, okay, maybe once a month, okay, what the trade is, where we're going. I will end up sending out images, again, not that often, maybe once a week. There's not a lot to end up looking at here. Most importantly, you'll end up getting text messages and emails when we get to a point of a trade. Okay. You'll end up getting history. I'll end up showing you what we've done when we've gone in, when we've gotten out. It'll be my actual price fills. And we'll end up doing the same thing. We'll do an expert forum for everybody to be able to end up going in. The reason why I think this is an important trade, and the reason why I've been doing this for my Kevlar subscribers for several months now, is because I ended up having a challenge, okay, when the market moved straight up. You can end up seeing here that I had my first losing month in December. January was rather small. My current February, we're up about 3%. Not nearly the almost average of close to 7% I had been doing a month. I struggle in my Kevlar when the market is in this grind up, okay, just, escalator to the top or elevator to the top floor type of market that we've been in the Trump rally, okay, since the election. So, okay, to me, this was a very nice complementary trade. Let me be very specific here. Both trades, okay, stand on their own. Okay, I would not be trading the Kevlar if I didn't think that one, I could either at least hold my own when the market moved up, okay, and then make a lot of money if we were a little bit up flat, a little bit down, or even a lot down, as long as we didn't go down more than 5% a day. Okay, or 8% a day. I can end up managing that, and I love that trade as a standalone. However, okay, I know the last few months have been difficult. Okay, so being in this trade, hang on, let me just pull it out. Right. Being in this trade, DXIV, I've had a nice little run. Okay, and it's been up, 30% on the money that I've put into this. I've been asked, how do I end up doing my allocation on a trade like this? And that's really a question up to you. Okay, can I end up having a 20 or 30% pullback in the XIV or in the VXX before I get out? Yeah, I can. Okay, I do believe that over time, okay, we have definite statistical advantage. We have roll yield working for us. On the XIV, it's really ends up helping when I go into the VXX. I'll have roll yield working for me on that trade. And so it works rather well. Okay. Let me make one last comment about the XIV because it is far from a perfect product. Some of you may have wondered, said, Jim, when we looked at the VXX, it went from, thousands, right, tens of thousands down to 20. Okay. How come the XIV doesn't go up as much as the VXX goes down in time, right? Has anybody noticed that? Have you guys looked at this? Anybody want to write in the chat? Okay, who's looked at it or make a comment on it? Does anybody know why the XIV doesn't go up, okay, inversely over the long run compared to what the VXX goes down? Okay. The term that I end up using is that there's a drag, but I call it inverse drag. Okay. This is what inverse drag is. Think about what happens if a stock price went from 100 to 110 and then back to 100. Okay. If we were long this product that went from 100 to 110 one day down to back to 100. DJ, exactly. I'm going to go through the percentage, okay, and how they're calculated. That's exactly the right answer. Okay. When we go up from 100 to 110, right, everybody knows that we went up 10%. What percentage did we go down when we went from 110 down to 100? The answer isn't 10, right? Because the answer is we went down 10 points, but now we're dividing it by 110, right? So 9-ish, yes, exactly. It's actually 9.09, John. That's exactly right. It's a touch higher than 9, right? Because if you take 10 divided by, and you can do it on your calculator, right? 10 divided by 110, it's 9.09. Now let's think about how the inverse product would work. On the day we went down, okay, we would go down 10%, from 100 down to 90. On the second day, we would go up 9.09%. If you take 90 and you add 9.09%, you get to 99. About, right? You just lost 1% on the inverse product versus the straight long product, right? So the inverse products have this inverse drag to them. Now, what affects that drag? Okay, this is a very important question. What affects inverse drag? Because not all inverses are affected by inverse drag the same amount. Well, there's two things that affect it. And they're both going to end up working back to DJ's answer about the percentages. The first one is how volatile, okay, or what's the ATRs, meaning what's the daily percentage, okay, movement? How much can it move up and down as a percentage of its price? Okay. Now, when you think about the VIX, okay, you take a look at an average price of, say, maybe 14, 15, and then you take a look at what the daily price movements are, and the daily price movements are huge. Okay? If I asked you, go and find me any security on the planet that has a higher daily percentage move from of the VIX, okay, you'd be hard pressed. I know that somebody's going to go out there and find some Chinese biotech or, some obscure commodity traded on an exchange in Bangladesh. And yeah, you're going to find them. I know. Then I'm going to end up asking you, okay, now find me not only one that has a greater daily movement, but find me one that has a greater daily movement and a greater reversion to the mean characteristic than the VIX. Because when you find me that Chinese biotech or that commodity in Bangladesh, they're going to go from, 2 to, 120. Okay, there's not going to be any reversion to the mean characteristics to this. The two things that kill an inverse product are how much does it move daily and how much does it go back to the place where it started from. Okay, what's the daily movement as a percentage, and what's the reversion to mean characteristics. Those two things, okay, you will not find a product, security, index, or anything that has a greater movement, okay, than a volatility product on an index like the VIX. I know you can go and tell me, oh, I found it on the on the RVX, which is the VIX for the RUT. Yeah, I know. How do I trade that? How do I make money off of that? This is the product that has the worst, right? The worst inverse drag. So here's our choices. We have a flawed product in VXX that has absolutely horrific roll drag characteristics and has gone from 14,000 down to 20, okay, over a number of years. By the way, it never traded at 14,000. It just gets reverse split, every so often, multiple times a year sometimes. Okay, so it's just has terrible okay drag. And remember where the drag comes from? The drag comes from the difference in the futures. Okay, the drag comes from having to end up selling 14. Sorry, this thing always moves. Having to sell 14.07 and buy a 15.48 most of the time. By the way, what's most of the time? If you go back from the time that the VIX, futures have traded, okay, and you can get all this data if you want. You do the math yourself. You find that you're in contango, more than 90% of the time. Okay, so this is going to be the norm. Okay, most of the time, and this is just a horrific drag. Well, not as horrific, but you have the inverse. Okay, in the XIV. Okay, you have the inverse drag. Now, when is inverse drag the lowest? Inverse drag is the lowest, okay, when the VIX isn't moving around as much. It's not popping up and down and up and down and up and down, right? It stays relatively constant. And what ends up happening is that you're collecting let me put this on this side of it so we can talk about both of them, right? You're collecting the roll, right? The futures roll drag, you're collecting that, and you're not paying as much for the inverse drag. Okay, so you got to go through all of this math to be able to end up figuring out, when is it optimal to end up getting in and getting out? How bad can you end up getting hurt? And after multiple years, I thought that, this is the easiest trade that I can end up sharing. It's simply, 3 states, long XIV cash or long VXX, and then that's it, right? I don't have to deal with options. It also ends up, for those of you who are options traders, we tend to end up liking to see a little bit more volatility. I don't know about you guys, but I tend to end up making more money. Right? If you take a look at these numbers, okay, I tend to make more money when the market's, more volatile, has bigger pullbacks. So to me, this was the perfect complementary trade. Okay, so what we're going to end up doing with this will end up being another paid class. And for anybody who is a Kevlar subscriber, we're going to end, and it's going to be priced like all the other classes. But anybody who's a Kevlar subscriber, you'll get it free until June. After June, we are going to charge, but we're going to give every Kevlar subscriber a 50% discount, right? 50% discount off of it. What we're going to end up doing if you subscribe to any other service, because I didn't want to end up leaving you guys out, because some of them also, I know, tend to end up doing better in certain environments. I didn't want to leave you guys out, so we're going to give you a 25% discount off of it. Okay. We'll end up having this up. Tom, how long until we end up having the website and we can have people start to end up signing up for it? I'll give it to everybody, free. Tom, did we say through the end of the month? Is that what we ended up saying?
For the vantage.
Yeah.
I can probably have it working this weekend. So yeah, if you want to give them 2 weeks, then it would be to the end of the month.
Okay, so what we'll do is that we'll give everybody, if you want to sign up for it to see what will end up working. And again, you're not going to get daily updates on this. There aren't daily updates on this thing. You can see that, I haven't ended up making, well, I shouldn't have made a trade on this thing since I ended up coming in here on whatever date this was, in mid November. We've been long, but I'll end up commenting on where we are. So everybody will get it, okay, at no cost for the first 2 weeks. If you want to end up signing up, we'll Tom, we can automatically sign up all the Kevlar guys through the end of June.
Yeah, that shouldn't be a problem.
Okay, so we'll automatically sign all of you guys up. Okay, all the Kevlar subscribers to the end of June, and anybody who wants to end up getting it, who is to any other service. If you guys want to do it again, you'll get a 25% discount from the time we started going. Tom, anything that I missed about any of those three classes? The free class that we're putting on the public site for Finance 101, the no-cost class for all members, all Gold members, and all subscribers on the homepage, and the vol, right, and that's the rolling leap diagonal, and then this one is the vol vantage trade. Did I miss anything from the way they'll end up working or the way folks should be signing up?
No, I don't think so. For the vantage, I'll get that. I'll automatically sign up all the Kevlar folks, and then I'll put a link on the website for people who are interested in following along. And the leap rolling diagonal, if you subscribe to anything already, you already have access to it. So, yeah. Jim and I have already talked about some changes we're going to make to that page and make it kind of like a little mini trade alert service. So not as complete as the other ones, but as far as like the education and the hand holding. But Jim's going to have images and recorded meetings, messages, trades. So it'll be fairly built out pretty soon.
Okay, and we'll have a library of classes, and what I'll probably end up doing is a WebEx once a month. I won't do as many recorded videos. I'll do more of a WebEx once a month on the leap diagonal, because remember, this is the way I'd like to be able to, kind of, Tom and I want to do this as a free service to anybody who's, like I said, a Gold member or a subscriber, so that it gives you, a learning opportunity. If you want to trade it larger, you want to use SPX contracts, you're welcome to. I wanted this to be a learning, experience. That's why I'm using SPX contracts and using only, $4,000 to $5,000 on it.
Yep.
Okay. A couple of questions I see. The first one was, are there any advantages on XIV versus SIXV? Y, I'm sorry, the SVIXI. Two, that I see. Number one, there are no options on the XIV. Okay. I don't want to have options, that would end up influencing the underlying unduly, and then have to trade through the price of the product to end up getting to the VIX futures. Okay. It's just cleaner, number one. Number two, volume is higher. It's older and volume is higher. The greater the volume, the dollar volume is higher, the share quantity volume is higher, so that means I have more liquidity. Does it make any difference? It means my bid-ask spreads will be tighter. Okay, I followed it for a long time. If another product comes out that's more volatile, has tighter spreads, and it's always penny-wide markets on this thing, I'll look at it. But until then, I'll end up using the XIV. I'll also make the same comment, by the way. It wasn't asked, but I'll make the same comment. Why the VXX versus any of the other VIX lookalike products? It does have options trading against it, but so do all of the other VIX products. But again, it's the most traded. It has, the greatest market cap. It has the most shares traded per day. It has the highest, and again, it's going to end up having greater liquidity. because of that, and the bid-ask spread is going to end up being tighter. And the pricing will tend not to end up drifting as much because if the price drifts, the high frequency guys will, whip it back into shape right away. Okay, so those are the reasons why I end up using the two that I've chosen. Okay, brokers charge. Oh yeah. Okay. DJ is just saying, why don't I just short? Okay, the VXX for example. Okay, instead of going long the XIV, right? Because it's pretty much the same trade. Um, I don't short it because the fees that brokers, right? It's not like we're the only ones in the world that figure this thing out. And so people say, hey, you know what? I'm just going to end up shorting, okay, the VXX. Well, the brokers know that, and they're going to end up charging you an arm and a leg, okay, for the borrowing fees on it. Number one, okay. It's a hard to short product, which means that your puts are going to end up being more expensive on it. It's also calculating it. And so trying to end up shorting this thing, plus you also have unlimited risk to the upside, right? If you're short the product, the way the percentages work, if we go up 10%, 10%, 10%, and I'm short the VXX, right? If we short 10%, if it goes 10% against us a day, is what I was saying. So the first day it's worth 110. Then the next day it's worth 121, right? Because the compounding effect goes into effect on it. So my loss can be much, much, much worse if I short. And then your margin requirements become a lot more because the margin requirements, okay, if you're going to short this thing, are a freaking arm and a leg also. I'd rather make this something that if you wanted to put in your RIA, I'm sorry, your IRA, your retirement account, you could. And so it ends up working, I think, just a little bit cleaner, and I prefer it this way. Can I give us an idea of of what we ended up doing? It's substantial. It is really substantial. There were times when we've done as well as we're doing right now, which means that there were 100% years. Okay, there were pullbacks as bad as 35%. Okay, um, but over the long run, okay, over the long run, it works, relatively well. I would not, if you're going to do this, I would not put in capital, okay, that I needed tomorrow. I would not put in capital where if I lost 35 or 50%, it would change my lifestyle. Okay, very, very important. Please do not overtrade. I'll go one better. If I find out somebody's overtrading it, I'll pull the service from you. I'll give you back your money. I don't want you to overtrade it. Okay. You do it with trading capital. This goes in your trading account. Where did I say I put it? I put it next to my Kevlar in my trading account. Okay. Tom, I think that was it. Did I miss any? VMAX and VMINs. Yes. Okay. I've taken a look at a lot of the math on and the algorithmic trading on these things, and the problem is that if you use any algo or any mathematical type formula on the price of things and the volume, if you try to do, you'll never see me. By the way, you'll never see me do technical analysis on this. Okay, technical analysis doesn't apply to any of this stuff. Okay. Don't end up telling me, oh, well, we had a resistance at this level before. So no, none of that makes any difference whatsoever. The only thing that makes a difference is where volatility is in the first few months and where they're going and what their relationship is. Okay. How far out do I look? I will look out as far as 6 months. I obviously don't care as much about how the 6 months, 5 and 6 are trading compared to how months 1 and 2 are trading, right? Because they're the ones that are going to have a bigger factor on the roll. Months 2 and 3 sometimes also have a factor on the roll. So they're also very important, not as important as months 1 and 2. So I will be looking at all of those. That's what I will be looking at to be able to end up putting this trade on. Yeah, John, it is a volatile, endeavor, okay. but it is a excellent trade. And if you have a portfolio, okay, or a trade that leans negative delta or is negatively correlated to the S&P, the way the Kevlar is, I think it's like the perfect complement. Both trades, let me make this point again. I said it before. Both trades stand completely on their own. Okay, when the market is ripping up, the way it is right now, okay, the vol vantage trade will print money. Okay, my Kevlar will struggle. When the market is volatile, okay, and moving down, usually the Kevlar will do extremely well in transition periods, meaning that we're ripping up and now we've turned and now the market's coming down and volatility spiking. During transitions periods is when the vol vantage trade can get chopped up. If we have a horrific sell-off, okay, we will get into the VXX. I will tell you that unless we have a sustained, not just pullback, but a sustained period of high volatility, okay, I tend not to end up being in the VXX trade nearly as long. Let me come over here and take a look at the SPY, SPX, because that's what it's based off of. So, when I take a look at, and I can't do it here, so let me go. I'm going to go to a weekly chart so I can just get more time frame in. Okay. When you take a look at this period that we were in, okay, for a year and a half, okay, if you take a look at this period, now the VIX futures weren't trading during this period, okay, but you can take a look at the VIX and you can end up making some assumptions on where things were. And I go back and I take a look at, okay, where the VIX futures go back to. You can see they only come back to here. You can see that they were extended, okay, for a very, very, we were up in the 40s, okay, for long periods of time, okay, for multiple months. You can see that, when will we get whipsawed? When the VIX ends up, popping up and then coming straight back down. Okay, there are times when, I will get whipsawed, but they tend to be small losses, right? Because I'll go in and then I'll end up getting right out. I tend to end up staying in the trades. Once we start making money, I will stay in the trades longer. Why? Because we're playing with the house's money. We can afford to have some pullbacks. Okay, this will give us the greatest realized return over the long run. Okay. What capital? I've been asked this. Okay, the planned capital. Okay, on my Kevlar. Okay, that I would end up doing if I was playing them as a pairs trade. Okay, my Kevlar is set up for a $50,000 account. All right, so if we come back over to here and you take a look at all of these numbers, okay, we started with a $50,000 account. If I come and show you this, okay, right, my P&L, okay, you can see here's the capital that I've used. I'll tend to end up using a total of $50,000 on 2 open trades at a time. Right now, I'm using a little under $25,000 on both of these positions that are open. I tend to end up doing that. So my capital allocation on my Kevlar is a $50,000 account that I use all of it. If I was using this as a complementary trade, right, as a complementary trade, I would use half that capital. Okay, I would use $25,000. Okay, am I using that right now? No. I'm using about $50,000 in the trade now that I've reduced it. Right, I had more as we've run up, and I have had capital. But why? Because I'm very, very confident. In the fact that we've had this. a very, very clean set of lines that haven't um, rolled over. By the way, you can see why did I stay in the market at the end of the year when we had that little bit of a pullback? I didn't get close enough. Okay, both came down. Okay. By the way, will I wait for a crossover? No, I'm not waiting for crossovers. Crossovers are too late. You can't have a two-state system of either being just long the XIV or the VXX. You'll get crushed and you'll get whipsawed to death on it. You need to have a safe zone, a cash zone, which I do. There'll be months sometimes when we'll sit in cash. Okay, if there's not a good entry, and the roll yields aren't going to end up making up for the imperfections of the product, okay, and the potential differences of the way the probability say, okay, the VIX futures will end up moving, I'll sit on the sidelines. Okay. By the way, which is fine for me because if we're bouncing all around but not really going, okay, very far in either direction, but we're having really big swings, only to come back to the same place in 2 weeks, that's an environment where the Kevlar just prints money. So that's why I consider them, so complementary. And for anybody who does trade the Kevlar, and you want to end up doing this, I want to make it as affordable as reasonable for you. Okay. Tom will end up sending out an email for anybody. We'll end up having it on the homepage. I see a couple of questions right now. First one was that Dirk asked me about skew. For those that you don't know about it, and I just want to finish up these questions and write in your questions now if you have anything else. And then I've been going a long time, so I'm going to end up calling it quits right after these questions. Skew, and I need a line chart. Sorry about this. Appearance, candle, line, apply. Okay. This is another calculated number that the SIBO had come out with. And what it's measuring is basically the skew on the SPX options, but I never brought this up, and I don't end up reviewing this because I think that it's more misleading than it is helpful. Okay. What it's showing you is the price or the implied volatility of the skew of the options that are so far out of the money that, quite frankly, they don't make any difference whatsoever. Okay. So, yes, we've had this really big spike, okay, in this. And that just means that options that I don't trade in my Kevlar, nor does anybody else that I know of in any of the other services trade, because they're so far out of the money, that they're useless. They really are. So I would suggest you don't use it, okay? And I wanted to end up saying that to everybody because if you are using it, just be very, very careful, okay? What's the planned capital? I answered. What's the skew? I answered. Okay. The trade service, okay, will end up being the same as all the other, okay, trade services. They'll start right. The Kevlar, okay, service is priced the way everything else is. They're $119, okay, if you pay month to month, and there are discounts if you end up going longer term. And like I said, Kevlar subscribers free until the end of June, then 50% discount. All other subscribers, any other service that you subscribe to, 25% discount from day one for everybody. Okay, so that's the pricing of the service. Tom, I think that was the last question. I don't think I missed any others.
Well, we're over time anyway,
Good.
so we need to wrap it up. So thanks, Jim. It was a marathon, but lots of ground that got covered, so thank you.
There were. Tom, let's talk about it. You may want to break it up into 3 separate recordings. Okay, you have the 3 different things that I did.
Yep, definitely can do that.
Okay, sounds good. I'll talk to you in a little while. Thank you, everyone. Thank you for sticking with us.